Spread in Forex means to you how much money you will pay to the broker for each trade you open. Each trade you open will be in minus for some amount. That amount is spread, and it is defined by the difference between buy and sell price. Those two prices are called bid and ask price. Here is an example of a chart where you have two prices and the difference between them is spread. Spread amount you pay on each trade can vary, and that depends on the broker, market conditions and currency pair you are trading. Each broker have its own spread, and their job is to offer you the best spread, lowest spread, in order to attract you to become their customer. Spread for you can mean being profitable or loser on Forex. If you have large spread, that means you will need to have higher pip profit target to make money. When you have low spread, it will mean that you will need less pips to be profitable on each trade. Image shows you how does the spread in Forex looks like. It is the difference between two prices. One price, which is ask price, is the price you will have when you want to buy the currency pair. For example, if you want to buy EUR/USD pair, you will pay the price 1.13353. Immediately you will be in minus for the amount of the spread. In this case, you will be in minus for 0.8 pips. If you want to sell the currency pair, you will get the bid price. The bid price is 1.13345, at which you will open the order, and you will be in minus for 0.8 pips, like in the case of buy order, which I have explained few lines above. How to calculate spread in Forex to get the information how much money is 0.8 pips. You need to calculate the pip value to get the value that you will be in minus at the start of an order. In the table I have listed a lot size in Forex you will have. I will use the case when you use standard lot size where 1 pip is equal to $10. When you calculate the spread from the example where we have spread 0.8 pips, we get 0.8 pip multiplied with $10 per pip equals $8. This means when you open buy order, you will be in minus for $8, which is not small amount. Now imagine if the spread is 20 pips. That large spread is on the less liquid pairs, like exotic currency pairs. 20 pips spread in Forex on standard lot size would be $200, which is large amount. Let's calculate the spread amount for 20 pips. 20 pips multiplied with $10 per pip equals $200. Know that pip value depends on the lot size you will use on each trade. The example above is for standard lot, which is the largest lot size among 4 I have listed in the table. If you use smallest lot size, which is nano lot, then you will have a value of 0.8 pips as following. 0.8 pips multiplied with $0.01 per pip equals $0.008. Your goal is to make money and not to lose it when you open the order. To prevent that, you need to have small spread as much as possible. You can use smaller lot size to lower the loss on each pip you have per spread. But you need to know that when you start making some pips, you will make less money by each pip. To be on the safe side and make more money with each pip, it is the best to have a broker that will offer you good spread. Typical spread in Forex, less than 1 pip is perfect. From 1 pip to 2 pips is okay, and about 2 pips is less attractive. Anything above 10 pips is something you should avoid if you are a day trader. Now, if you are a day trader, that means you will trade often. Several trades per day. So any spread that is larger than 2 pips will give you loss of your money on each trade. When you sum all trades per day, you can end up giving a nice sum of money to your broker. If you are a swing trader, and that is trader that open a trade once a week or 2 weeks, then a spread of 2 pips will not make a problem to you. Reason is that you will try to make money by trading with the trend, where orders are usually with several hundreds of pips of profit target. If you open 1 trade per week with spread of 2 pips or 5 pips, that costs you, for example, $2 or $5. That will not be a problem because you are looking to make 100 pips, which will give you $100 or more. I will show you 3 examples with 3 different spreads. Each example is using standard lot size for easier understanding of comparison. On each chart, I have drawn a distance between ask and bid price to extract the spread amount. On the chart I have drawn a lines to explain one spread that is pretty decent, and it is usual spread that broker offers to day traders. I have Euro-USD pair as an example because it is the pair with the lowest spread on the market. Current spread is 1.3 pips. One test order is open with one standard lot. I have explained earlier the lot size, so you can take a look what is the pip value of one standard lot. When I open the order, I will be in minus for a spread. At the start, I am in minus for 1.3 pip, which is for standard lot $13. It is initial cost you need to pay. Because you are using variable spread instead fixed cost per trade, this cost can be variable. What is variable cost or variable spread? I will explain later in this lesson. If you take $10,000 account and compare it with $13 of loss at the start, you can say it is not too bad. That small costs to enter in the trade where you can make hundreds of dollars is not too big problem. What will happen with the costs when you have larger spread on Forex pair? Take a look on the next image. This example shows you GBP with New Zealand dollar pair which have medium-large spread in Forex. Current spread is 3.9 pips, which is almost 3 times larger than on the Euro-USD pair. I have opened test trade to show you how much you will be in minus when you open the trade. I have opened one standard lot, and my current balance tells me that I am in minus for $25.03. That is the cost you need to pay to broker in order to open buy or sell order. That is quite a larger minus compared to Euro-USD where I had $13. Large spread makes you start harder if you are hunting for few pips. Your entry costs are high, and to cover that cost you need to trade very well to cover them. Take a look on the next image with pretty high spread in Forex. I have used exotic currency pair in Forex, US dollar against Polish zloty. Current spread on this pair is 20 pips, which is high spread. When I open one test trade with one standard lot, I will be in minus for 20 pips. When I calculate the pip value and calculated the spread, I get minus $50.43. At the start, when I open the trade, I need to wait 20 pips in profit until I get even. The $50.43 is the cost you need to pay to open order. Whether it is buy or sell, it doesn't matter. 20 pips at the start is too high cost, and you should avoid using pairs with high spread. If you like to trade these pairs, then you should trade where the profit target should be several hundreds of pips to make it worth trading these pairs. What are the steps you can take to minimize the spread and lower your cost? First, what you can do is to find the best broker who can give you the lowest spread. If you minimize the spread on all Forex pairs, or at least on the ones you will trade, then you will minimize the cost. Second step you can do to minimize the spread and costs is to select the pair with lowest spread. Do not trade exotic cross or minor currency pairs. That way you will minimize the spread under 2 pips. All major pairs mostly have the spread lower than 2 pips. Any minor or exotic pair will have spread from 3 or more pips. By paying attention on these 2 steps, broker and currency pair, you will manage your risk exposure and you will minimize your cost. So what affects a spread in Forex? Forex spread has several factors that can have an influence on it. Those are news that can bring high volatility in the market, which can cause the spread to widen. Second factor can be the currency pair. Is the currency pair attractive or not to traders? Remember one thing about the spread. If the spread is not fixed, meaning it is variable and can change its amount of pips, the number of pips in spread will depend on the volatility of the pair. How do news affect the spread in Forex? News are a factor that affects the spread in Forex. When the news are published, or even few minutes before and after the news, volatility increases. Volatility increases because many traders are expecting the news will bring the desired outcome. The traders are entering the market with expectation the price will move in their favor. But because many traders are entering with sell and buy order, the price jumps all around. That volatility increases the spread because brokers need to accept many orders from traders. You need to know that mostly brokers works in a way that they accept the opposite side of the trade when the traders open buy or sell order. When the news hit the market, many orders are filled and many orders closes because of wrong prediction of a trader. The high volatility in this case is not okay for a broker because of uncertainty. The uncertainty can increase broker costs, so to prevent the loss on many trades in case of news, they increase the spread. That increase can sometimes be from 2 pips to 20 or more pips, depending on the pair. The solution not being stopped out because of increased spread is to avoid trading before, during and after the news. Just stay out until the market comes down, that is around half to 1 hour or few hours before and after the news are published. Image shows how the market reacts when the news are published. If you check the difference between low and high on 4-hour time frame, you will see change in 270 pips. If you take in consideration that your Euro-USD pair have around 80 pips change in a day, then this 4-hour change is a lot. On these news, the spread can change and increase, and it is the best to stay out and wait until the market comes down. You can see the price have increased quickly and then get back where it started to increase. That is the volatility that comes with the news and which affects on the spread in Forex. Imagine what would happen if you open buy order on this situation. You would enter into buy, the price would go up, and you would think, great, I will make money. And then the price reverses back and continue moving down where you end with a loss. That is common situation with news trading. Let me explain which types of spread in Forex exist. There is fixed and variable spread in Forex. Variable or fixed spread have pros and cons. Here I will explain each spread type. Fixed spread type is when the broker offers you a spread that does not change. That means if you make an agreement with the broker, you can have spread of 1 or 2 pips. Fixed spread means that you will have fixed cost for any trade you open. If you open buy or sell trade, you will pay same amount of money to broker. As an example, let's take a situation where the spread is 2 pips. You are opening an order on Euro-USD with $1,000 account. The value of a spread when you open standard lot is equal to 2 pips multiplied with $10 per pip equals $20. You will have $20 cost each time you open order. This amount will not change. The limit you will have is that you will not be able to open order when the news are published. Broker can make a statement in your contract that they cannot allow trading in case of high volatility news. They want to protect themselves from losing a lot of money. Here are the pros and cons for fixed spread. Pros are fixed spreads allow traders to rely on a fixed cost on each trade. Cons are fixed spread type is not available for scalping. You can have a requote when opening an order because broker cannot adapt their offer to new market conditions. Let me explain now variable spread. Variable spread is a type of a spread that many traders use. It is a spread that changes occasionally. The spread change can be in a minute or few hours. That depends on the broker. The broker tends to change the spread as rarely as possible. No one likes to have variable spread that changes a lot. All traders like to know how much the spread will be on the trade they will take. Variable spread will change when the news are published or when the market volatility is low. Volatility decreases each night on some pairs because many traders are sleeping at night. When the market opens in the morning, the volatility increases and the spread decreases. Pros for variable spread type are there are no requotes. Spread can be lower than fixed spread in some cases. Cons are spread can change in seconds depending on the market conditions. It can trigger stop loss in case of a large movements, which can lead to losing a trade that could be profitable. At the end, here is a conclusion about the spread in Forex. Forex spread is one thing you need to pay attention to. It is the cost you will have on each trade you open. Your goal should be to lower the cost, and that is by trading with the broker that offers lowest spread and to find the pair that has the lowest spread. Spread is the difference between ask and bid price, and it can change how the volatility changes. To avoid fluctuations on the spread, you can choose fixed spread type instead variable spread type. That way you will know how much cost you will have on each trade you open. When selecting the broker, use the one that is regulated and that offers the lowest spread. Have in mind that broker that have the lowest spread is not the best broker, not always. but you can find decent broker with decent spreads that are acceptable. Thank you for listening. See you on the next lesson and happy trading!